Hi, I'm Joe DiNapoli. Welcome to the DiNapoli Leading Indicator YouTube channel. Your look into the future.
We're ready to go. We're ready? Yes. Welcome, Joe.
Well, I'm happy to be here.
Great.
I want to say,
You go.
I want to say hello to all my Polish friends. You know, I love you guys. I've been going to Poland now for 25 years. I know the country, north, south, east, west, and you're the best. I mean, I love the country. I love the people, and I'm real happy to be here today. And hopefully you're going to learn something. One request, because I have a hearing device in my ear. If you could keep the noise down in the room, just because I get that echo and it's going to screw me up when I'm trying to teach you something. So if we can, you know, keep that at a low level, that'd be good. What I want to talk to you about today is something that has taken me probably 50 years of trading to figure out, and that is, how do we approach the market? Do we approach the market using fundamental analysis? Do we approach the market using technical analysis? Just, you know, what's the best approach, and how this is going to impact you if you're trading for the next, I don't know, for the next 20, 30, 40 years, however long it's going to be when you're trading. So I want you to listen up. I think this is really a very important presentation. Now we're going to get to some specific current analysis on gold, silver, stuff like that. So, you know, if you pay attention, we're going to get to some specifics later on. But right now, it's how do fundamentals and how does reports, et cetera, affect us in our ability to make money. So let's go back. Can we get me, I'm seeing myself all over the screen here. Can we put me in a little box and get my presentation showing better, or is that something I do? My slides are, there we go. That's what I want to do. Okay. Most of you guys know I've been trading actively since 1967. And about 1970, there was this guy called Louis Rukeyser, and he did a program called Wall Street Week. And all of us that traded, you know, we waited for his presentation, usually on Saturdays. And we wanted to see what Louis and his group was saying about the markets, because he was the most sophisticated guy on the planet at the time, and we figured we'd be able to learn something. We actually figured we'd be able to make some money by watching this guy. And he did this presentation from basically 1970s to 2000. And I watch it religiously all the time. Now, what was interesting about his presentation was later on, say around early 80s, mid 80s, I started to learn about Fibonacci analysis, and I started to apply it to the markets. And when I was listening to Louis early in my trading career, I didn't have enough money to be buying $30, $40, $50 stocks. So I was always buying, you know, $2 stocks and looking for them to double on very high margin. So that was my approach. But as time went on, it got into the mid 80s, I had more money, and I was willing to buy some of the stocks that were recommended on his program. And what I noticed when I did my Fibonacci analysis was that all of his recommendations, or almost all of his recommendations, stock XYZ, they were at the XOP. They were at the furthest most buy point when they came out and did the recommendation. And we know that the XOP is tremendous resistance. And so right there, right when this announcement was being made in this program, buy this, buy that, these stocks were right at the XOP. So if you bought them at that level, you would have been killed. so basically his recommendations, see, other people knew that he was going to be recommending this stock or that stock. So they bid the stocks up prior to the announcement on the show. And the rest of us that were watching the show were supposed to buy those stocks from the people that had already had a position in those stocks. So in this case, news, fundamental analysis, you would call it, certainly worked against us. So let me tell you about something that happened to me. It was very interesting. And now we're going to jump up from 1970s, 1985. We're going to go up to the 1990s. And in the 1990s, I had become very, very popular in America. And everybody wanted me to speak and, show DiNapoli levels. So this got off, people in Asia started to find out about me. And I was offered a lot of speaking tours. I was offered speaking tours in Singapore and Malaysia and Thailand, Cambodia, all these different countries. And of course, I hadn't traveled back then, 1990, and I was dying to go. And they treated me well, first class accommodations, etc. So I would go and I would speak at these places. Well, in those days, we weren't using email. It hadn't happened yet. So we were using these fax machines. And in the US, many of the other experts that were teaching people how to trade the markets offered me their newsletters. And their newsletters, offered them for free in the hope that I would recommend them because, like I said, I was extremely popular. And so if I said this newsletter or that newsletter, one of the guys I know was Robert Prechter and Elliott Wade. But anyway, they would offer me these newsletters. And since I was in Asia, there was no way for me to get them quickly. They would come in late and they'd come in by fax machine. So what I would do, I'd do a presentation, I'd be relaxing in my hotel room and I'd get these faxes and I'd usually get them and I would get to reading them about probably 10 days to 2 weeks late. And so I'd read these newsletters and newsletter after newsletter after newsletter, I would ask myself a simple question. If I had had this newsletter when it was first published, would it have done me any good? The answer is no. I mean, the vast majority, once in a while, sure, there was a recommendation that might have made me some money, but I'd say roughly 90 to 95% of the time, these newsletters, all this information that I was getting, mostly fundamental, some of it technical, wouldn't have done me any damn good. Geez, that's weird. What's the point of reading the newsletter if it doesn't do you any good? And then I thought back to my days watching Wall Street Week, the same position in Wall Street Week. So now, today, we have a lot of these podcasts that come on to YouTube and other social media platforms, and they talk about what the Fed's doing. And some of these things that the Fed is doing, this is what you would call financial alchemy. They've got quantitative easing, which are bailouts, reverse repos and reverse market interventions. We've got primary market corporate credit facility, term asset-backed securities loan facility, municipal liquidity facility. All this is the stuff that the Fed is doing to try to keep the markets alive. Commercial paper funding facility, bank term funding program. We always want to know what SOFR's doing. We got the standing repo facility. We got dollar swap lines. There is so much financial bullshit going on in the markets. Nobody can keep up with it. But we've got a couple of podcasts, two in particular. I'm not going to name names, but at least one of the two guys, probably both, they're brilliant. These are smart people. And they talk about all this crap. And the indication is that if you understand all this financial alchemy, that you will somehow be able to use all that information, apply it to the market, and make money. Well, it doesn't work that way. While I might be interested in watching the programs and I might understand only 10% of it, many, many times I watch these people and they talk about, oh my God, we have SOFR going back to where it was 2,000 years ago. We had a situation. No, they're freaking out over whatever one of these facilities is doing. And I go, oh, geez, my goodness, my short positions must be doing great. So I go in and I start my machine up and I look at my machine and we got the S&P up 0.5% and the NASDAQ's up 1.5%. I'm going, oh, this financial calamity that these guys are talking about, what in the hell? Why is everything up? And this doesn't happen one time, two times, three times. It happens all the time. The more they're panicking on TV, the more the craziness on TV, the less it seems to affect the market. So what I'm trying to say is that if you're spending your time trying to learn about all this financial alchemy, my idea is that you're wasting your time. I don't think any of this stuff is going to help you to make any money whatsoever. And you could spend your life trying to learn this stuff. It is incredibly complicated, and it's complicated by design. And I might say one other thing, with all this crap that the Fed's doing, it is causing major distortions. It's like pressing on a balloon. You press on a balloon, something's going to pop out this way or something's going to pop out that way. And two things that we've got going on, which are absolutely terrible results of all this financial manipulation, is number one, we got tremendous wealth disparity in America. I mean, it is really bad. Vast majority of the people don't know how they're going to feed their family. And then you got a few oligarchs way on the top. And this financial engineering has made it worse. On top of that, home prices are so high, you can't buy a house. Young people can't buy a house. And therefore, we don't have family formation. And the birth rate's dropping. So, all these games that they're playing really isn't doing us any good and doing us a lot of harm. There's a business cycle. Let the business cycle happen. Let it happen and let it go through and change like it normally did, like it did when I was trading for most of my lifetime. Okay, so Louis Rukeyser didn't do me any good. All this financial engineering crap, which admittedly I really don't understand, that doesn't seem to do any good. And getting newsletters, mostly on fundamentals, when I was back in the 90s doing the traveling, that didn't do me any good either. All right, let's talk about government reports. Recently, there was a government report that came out and it indicated that there was a downward revision in unemployment. Unemployment and inflation reports are probably the most important thing that traders look at to try to make trading decisions, to try to make money. So let's talk about unemployment. There was a downward revision by almost 1 million jobs year over year. Not 10,000, not 20,000, not 100,000, almost 1 million jobs. So what good does it do you to study unemployment reports when they're bullshit? All right, now let's talk about inflation. Shadow Statistics. This is a website that actually tracks real inflation. Shadow Statistics. From approximately 2020 to 2025, when you compound actual inflation, it is up over 100%. Over 100%. If you use the official US bullshit calculations, the inflation rate is up about 24%. So if you use real inflation rates, we're talking about a 50% loss in your buying power. So if you had $1 million back in 1920, in buying power terms, it's worth $500,000 now. If you had, if you were using official government statistics, your buying power would be down by about 20%. Well, we have a way of calculating inflation here at Coast Investment Software. Let me show you something. I don't know if you might know what this is, but this is a thermostat. All right. Now, why am I showing you a thermostat? It regulates the automobile temperature. When I have my off time, and I have a fair amount of off time these days, I restore cars. This is what a 1955 Mercury looked like when it was fairly new. It was back 1960, 1958. All right, this is what this car looked like when I got it. And it looked, like this. Now, what happens here is that since I restore cars, I get car parts coming in here, or I get fasteners, or I get tools literally daily. I mean, it's like a shop. I mean, I get this stuff coming in every day, day after day after day. And I want to tell you just about this one part. So it gives me a chance to see what's happening in real world inflation by tracking this stuff. And I do track it. I see what's going on. Well, this thermostat, which is for a 351 Cleveland Ford motor, which that car got, should cost about $7.18, roughly, right around there. This little baby costs $36. $36. All right, now, that's expensive. But it's kind of a special thermostat, so maybe it shouldn't be used to judge actual inflation. Well, how about this thermostat over here? This is for a 1966 Mustang. 66 Mustang, okay? Pretty common, 289 motor, hundreds of thousands of these motors were made. That likewise should cost maybe $6.75. That one that I just bought cost $14.86. So this is giving you an idea, and same thing's going on with tools, and same thing's going on with other car parts. And if you don't, you've heard this stuff about the tariffs that Trump is putting on. If this doesn't cause inflation, I don't know what does, because car parts, fasteners, tools have gone through the roof over the past few years. Now, let me find the right slide here. For some reason, my slide's not going back. There we go. Venezuelan stock market. I want to show you how inflation affects the markets. Because if you're looking at, okay, do we have a recession going? What are the unemployment statistics? I've already tried to prove to you they don't do you a damn bit of good because the government's lying to us. All right, but let's talk about how inflation actually affects the market. Venezuelan stock market, which we can't say that they're doing great economically, is up 1,500% year over year. The economy, who cares? Who cares? Inflation is what's causing these markets to go up. And the inflation rates you get from the government are bullshit. So we've gone to Louis Rukeyser, we've gone to reports that we get late, we've gone to certain fundamentals, and what I have to do is say that none of this stuff works. It doesn't help you to make money. Crap in, crap out. In other words, if your analysis is based on faulty information, your results are going to be bad. Now, let's talk about the fundamentals where you guys are. You're in Europe, obviously, and I'm going to tell you what I've been hearing over the period since roughly 2021, 2022, when the U.S. took out the Nord Stream pipeline. We have heard that you're freezing. We have heard that your economy's gone to hell. We have heard, especially in Germany, we have heard that the locals in Germany are searching the woods to find wood to burn to stay warm. We have heard that pensioners are freezing in their homes and dying. Now, I don't know how much of this stuff is real, but what I'm telling you is that this is what we in the U.S. have heard. Volkswagen's in trouble, chemical industry's in trouble, paper industry's in trouble because of the energy situation. You're no longer getting cheap energy from Russia. So obviously, if you listen to all this stuff and you believe it, you would expect that that market, especially Germany, but Europe in general, would go down. Well, here we are. This happens to be this happens to be a German ETF. Now, take a look at this thing. We're back here when the pipeline was blown up. Absolutely visionary thing from the U.S. You know how smart they are. Anyway, after that happened, what we're doing is we've got an up market in Germany. The market goes up, goes through the MACD predictor. You guys recognize this. This is the stop grabber, or maybe if you haven't studied DiNapoli techniques long enough, this is a more sophisticated technique. But it is a technical indicator that we're going to take these highs out, and we took the highs out. We continue to go up. We have another stop grabber, and we're taking the highs out. So what's happening here is that the news is telling us that you guys are freezing to death, that all your businesses are going to hell, and the market's going straight up. So if you got that information from the news, if you were listening to the news, and you went, oh boy, Germany's in terrible shape, let's short Germany, you'd have been in big trouble. How do I know? Well, because I had a short position in Germany. Okay, if you look at this based on Fibonacci analysis, you can see that from that low that occurred back there in 2022, that we had just recently hit an XOP. Now, according to technical analysis, you had all these reports from Germany being in trouble. You wouldn't have gotten in trouble using DiNapoli technical analysis. Rather than being short, you would have been long. All right. Now, I don't know what the news is saying about Germany and about Europe in general. I know there's supposed to be some liquidity happening from your central bank, et cetera. But right now we're at an XOP. So the DiNapoli technical analysis is saying, hey, look, this thing's not looking so good. I don't know what the news is saying because I'm really not listening to news about Germany. But with all these talks about war, I can't imagine it's terribly positive. But now what we've got is we've finally got a technical indication that this market has hit a high and could likely come down. And of course, we have some support levels down here, a confluence number. What I'm trying to say is, if you use fundamental analysis and you use reports, you're going to end up being in big trouble. If you use technical analysis, no, it looks like the technical analysis is going to keep you the right way. Well, let's see if this happens on other stuff. When Trump got in 2025, the whole preceding year, he was talking about drill, baby, drill, drill, baby, drill, how the U.S. is going to loosen up regulations. They're going to allow a lot more drilling. They're going to produce a lot more oil. So Transocean is a stock that I've watched and I've followed and I've been in and out of for a fair amount of time. Now, this whole period where Trump was talking about drill, baby, drill, which is this area down here, all right, look what's happening. Even though Trump is saying drill, baby, drill, and Transocean is a driller, that's what they do, look at what's happening to the stock. So if you listen to the news, and if you tried to play this stock according to the news, you'd have been absolutely killed. You'd have been wiped out. And this stock was once $170. So, I mean, it would be reasonable, okay? It would be reasonable for us to assume that since drill, baby, drill was in play, and since Trump was likely to get back in the White House, and he actually did, all right, we would assume that this stock would go up fundamentally. But if you look at the technical analysis kept you out of this stock because the technical analysis was negative. And that's exactly the way it should have been. Again, technical analysis, you see, technical analysis is much harder to lie. Yes, stocks, futures, it can be manipulated, but not like the news. What happens with the news and what happens with reports is that there's this whole slew of people that get them ahead of time. They position yourself, just like with Wall Street Week, they position themselves ahead of time. By the time the news trickles down to you and to me, okay? You know, I trade some pretty good numbers, but no, I'm in the same boat you are. I'm not one of the elite. I'm not part of the Congress. You realize that Nancy Pelosi is one of the best traders ever known to Wall Street? Yeah, she is. And of course, she is the representative from California, and she had access to inside information. She is one of the group, the club, that gets the information ahead of time. How the hell do you think she made so much money? Because she had inside information. She got the news before we did. It's very hard for you to get the high-low last if you're in Congress before we do. It all happens at the same time, so they don't have any advantage. So technical analysis gives you an even playing field, whereas fundamental analysis, we're behind the 8 ball. Like George Carlin said, it's a big club, and you ain't in it. I'm not in it either, but the elites are in it. So they take advantage from news that is not yet known, where we don't have that advantage. Let's go on. U.S. 10-year notes. Let's take a look at this for a minute. What this indicates, this huge fall in U.S. 10-year notes, indicates that interest rates going up. Now, you guys are all sophisticated enough to know bond prices go down, interest rates go up, okay? All right, so just keep that in your mind. Interest rates are going up through this whole period of time. Now, let's look at the next slide. This is the Russell 2000. Now, the Russell 2000 is made up of smaller companies. It's said that half of the companies in the Russell 2000 are essentially bankrupt. But the reason they still survive, the reason they still go on, is because interest rates are so low that they could borrow money at zero, basically not pay it back, or you don't have to pay it back when the interest is zero. It is zero, right? So these companies are able to survive and go forward in time. However, as interest rates increase, what market commentators, fundamental market commentators, were talking about on YouTube constantly, over and over and over again, just saying the Russell 2000, these companies are going to go out of business. They're going to go bankrupt. As interest rates go up, they're going to be in major big trouble. And the Russell 2000 is in absolutely terrible shape. Yeah, well, let's take a look at what really happened. All right, we're back here, and the Russell 2000, all during the interest rate increase, is going up in value, up, not down. Now, if you were playing fundamental analysis, if you were using this to make your decisions, you would be in horrible trouble. You would be against the market. If, however, you are using something as simple as the MACD predictor, you would see that you are on top of that MACD predictor, and this market's going straight up. Now, we had some consolidation, and we just made new highs. This is interest rates are still gone from 0 to roughly 4%, and these companies are paying a lot more than 4%. But the Russell 2000 went up, not as expected, went down. So what good did listening to YouTube do you? That's the question. All right, what's our job as traders? To buy Facebook at 25 and sell it at 400 or 600, to buy Tesla at 150 and sell it at 400, to make 150% of our 150% of our money annually. No, that is not our job. If you think it's our job, good luck. You're going to lose everything. All right. What our job is as traders is to evaluate risk. That is it. And risk is extreme. So let's take a look at some of the risks we have out there. Extraordinary liquidity risk. Now, this isn't liquidity that I'm talking about where the Federal Reserve, pumps money into all those crazy facilities I was talking about later. That's not the liquidity. I'm talking about market liquidity. Market liquidity is what's on the bid. And what's happened, and I'm going to prove it in some upcoming charts. I've been talking about this for years, and I've been right. What's happened is that the machines have taken over the markets. And they're the guys on the bid and they're the guys on the ask, and they make money on the spread. What happens is that they are programmed when markets get too volatile to draw back because they don't want to get killed like they have, flash crash and several other times. So what happens is there is a complete derriage of the bids. Bids go away when the market gets really, really volatile. So this is an enormous risk. And my prediction is that there's going to be a day when, it could happen anytime, there's going to be a day when you're going to want to sell, or somebody's going to want to sell, and there ain't no bid. In other words, you got $150 stock, bid at 86. You don't think that can happen? Okay. Watch. Next, we got overvaluation risk. And like I was saying before, like in the Venezuelan stock market, people looking at overvaluation and people looking at all these metrics that test the market, people looking at recession. This stuff doesn't count anymore. What counts is inflation and certain other market internals that have very little to do with normal metrics that we use to assess where the market should be. So we got overvaluation risk. We got management risk. That is who's in charge of things. That's who's in charge of some of these big companies. Look, I run a corporation and I am involved in another corporation. And let me tell you that legally, books can be adjusted to indicate things that aren't true. We don't do that because we don't want to take that risk, have somebody look into it. But it's something that can be done. Inflation and excessive debt risk. We've already talked about that. Political risk. Political risk is actually what worries me more than any of the economic risks. Now, some economic risks are political risks, like inflation. But basically, I'm talking about things that really worry me are things like social disruption and wars that worry the hell out of me. And we've got bubbles all over the place, real estate, equity, and bonds. Now, if you're a young guy, if you're, 25 years old and you got 50 grand and you want to margin it up and, go balls to the wall and just go for it, that's one thing, okay? I'm not 25 anymore and I don't want to take the risk, which might, and I think looking at the group right now, I'm looking at you all, there's not a lot of 25-year-olds in there. If you guys get in a situation where you lose 30, 40, 50, 60% of your money, like me, you're going to have a hell of a hard time coming out of it. This is going to be a real problem. So trying to get that last 10% or last 20% and risking 80% may not be worthwhile. It's not for me. And like I say, political risk is my biggest concern. The political situation here in America is terrible. I'm less familiar with Europe, but my feeling is it's very similar with you guys, that the people come last and the elite, the Congress people, come first. They do everything in order to get campaign contributions and in order to be promoted and get free haircuts and go first class everywhere and stay in the best hotels and get insider information. Everything's for them. Shit is for us. That's the way the system works. And the system ain't going to go on like that forever. People are getting very, very, very upset. Now, we've got money printing to the max. Okay, this is a political risk because of some of the things I told you earlier, the wealth disparity and the ability. We can't have family formation here in America. Nobody wants to have a wife living in the cellar with their parents and have a child. People want their own home, and you can't even get a reasonably priced apartment here in America anymore. We've got some shortages, as I said earlier. My $36 $7 thermostat. We've got when Biden went out, he had a 35% approval ratio. Actually, it was less. And I'm going to talk more about this in a minute, but the Trump MAGA coalition in America it's over. It's done. Trump isn't losing support. He has lost it. He is in major trouble. We'll talk about that in a minute. But this is creating political risk. Unequal application of the law. Boy, I don't know about you guys, but elections here are no longer fair. I mean, that's just one thing. And if you got a political enemy, you just sick the DOJ, Department of Justice, on these people. I mean, it's brutal. That's unequal application of the law. We have complete and utter disrespect for the FBI, the CIA, CDC, FDA, you name it. And American cities are war zones. I mean, they are unbelievable. Look, I spent a lot of time in Bangkok. I lived there for 20 years. I would rather be in Bangkok at 2 a.m. Anywhere in Bangkok, much rather than in Los Angeles. I would rather be in Beijing than in Seattle. I mean, Beijing is far safer. What about Shanghai? I'd rather be in Shanghai than Boston. The cities are not safe. You can't walk in American city. I've got Asian friends saying, hey, we'd like to visit America, but, we're afraid something's going to happen to us. They say, hey, it's not just you guys. This is going to happen to any of us. American cities are not safe. I mean, so what does this mean? This means a breakdown in the society. Now, let's look at the top, okay? Let's look at Trump. I never in my life under a Republican administration thought that my tax dollars, which are significant, would be supporting baby killing. And they are. It's unbelievable, but it's happening. So all this stuff is bringing on political risk. And there are two political risks that I'm really, really worried about and I want to share with you because they impact the market. I'm not trying to make a political statement here. I'm trying to talk about the markets. And two political risks really have me worried. One is Trump. The Trump of 2016, if Trump, 2016 met Trump of 2025, he would not recognize the guy in 2025. I used to support Trump. I provided campaign contributions. I bought his merchandise. I had a big sign up in my house, Trump. This is back in 2016, 2020. I mean, I was MAGA all the way, right? Yeah, I no longer support this man. His t-shirt with his picture on it, I tore it up and I used it to sop up primer that I put on my car. I mean, this guy's gone bonkers. He is nothing like he was before. He's turned into a warmonger. He's a murderer. He kills people in speedboats just to show how strong America is. Can't take on Russia, can't take on China, but we'll crush Venezuela. We're going to show them how strong we are. Puts in tariffs, which are nothing but a tax. Talks about transparency, and then he protects pedophiles. I mean, he's lost support. He's lost major support. He's an egotist. I knew this back when I was supporting him, but I did anyway because I thought he was a good man. I no longer think he's a good man. What I'm getting at is I think he's dangerous. They're going to lose the House. They're going to lose the Senate this time next year. And when they do, he's open for impeachment. I'll make a prediction right now, and you may seem kind of crazy, but I don't think he's going to finish out his term. I think the shit's going to hit the fan. This is going to affect the markets. Right now, the U.S. economy's going tapioca, and he's trying to find some way to keep it back together again. So this is one political risk. The second political risk is Israel. Israel isn't losing support in America. It has definitely lost support in America. Not among the elites because they're getting paid off. That's what they like. They like the money. Speaking of money, Israeli lobby and Israeli interests gave, this is the fact, okay, $225 billion to Trump. You wonder why baby killing supported? Okay, there's your answer. So Israel's losing support. And what about this? Why am I concerned about Israel losing support? Well, based on what they've been doing, when they realize that they have lost support, which they are realizing now, they're going to get crazier. And when they get crazier, it would not surprise me if a nuke starts flying. And those are the two political risks I am really concerned about. So if you're going to be long stocks, walking into either of these situations, my advice to you would be to watch out. Now, I have, as you've been coming to previous DiNapoli days, then you'll know that about 70% of my money is in cash or cash equivalents, and about 30% I trade with. Now, what that looks like is that in my accounts, I have standing orders, and those orders, I mean, like now, these numbers are not real. I'm just trying to make a point. But like, if Facebook is trading at 600, you know, my standing orders would be Facebook, buying Facebook at say 4.25. I mean, they're way under the market, way under the market. They're standing orders, they sit in the market, and they're at DiNapoli levels. They're at places where I want to buy, but they're deep. They're really deep. That's the way I handle things, especially in market situations like we have now. So even though I'm only trading with 30% of my money, when I have big situations happening, like in 2022, this is the picture of the NASDAQ. We came down to major support here on a high time frame. I think this was a quarterly. We came down to this big, massive support area. I was a buyer, even though I'm negative the market, even though I don't want much risk. In situations like this, I'll take that risk on. All right, so I was a buyer here. And when you look at the S&P futures in 2022, we're right down to massive support. Well, what happens is we have these major support levels. I'm willing to be a buyer. And those markets the market orders, they're not market orders, or better orders, but those orders that are in the markets at very deep levels, they start getting hit. Bing, bing, bing. So if I have 30, 40 orders sitting there in the markets, particularly overnight because it's still liquid, I'll come down and I'll start getting these fills. And if I'm at strong support and I'm close to getting a fill, I'll go back in there and I'll cancel replace and go at the market. Then I'll use the bread and butter technique. This is one of the best techniques that we have as DiNapoli traders. Massive thrust, pull back to an entry like in 2022, and then exit at the 0.618. And here's what happens. We come up, there's your entry, there's your thrust, 2022. We come down, there's your entry, and here's your 0.618. This is where you get out of the market. And this is a safe trade. I'm not saying the market's not going to go to a COP or an OP or an XOP. In fact, it did. I didn't know that it would. In fact, it did. But I made a nice safe profit coming up here, and I went short. I closed those short as soon as we exceeded the 0.618 on close. That told me the shorts were wrong. All right. Now, what's the point? And so I got out with a small loss. I had a big gain from this low back up here. Then I had a small loss. Now, what's my point? My point is that by looking at technical analysis, looking at our Fibonacci levels, looking at the bread and butter trade, we can make a safe, even though it's a risky environment, we can make a relatively safe trade by employing the technical analysis techniques and turning off YouTube and not paying attention to the freaking news, right? Because, I mean, everybody was negative. I don't know if you guys realize this, back in 22 when we hit that 0.618, everybody and their grandmother and their grandmother's dog and the cat, they were all negative. And if you listen to all this stuff, you wouldn't have taken advantage of this long play. By the way, I did not take advantage of the long play because political risk was so intense that I was not willing to take the market buy signal. But there was a buy signal. And I did close my shorts. Actually, I spread off into gold and silver. So if I had short positions, they were offset by gold, silver, palladium on the long side. Let's talk about let's talk about April 2025. Just recently, we were doing a lifetime trading seminar on the Monday after the Friday that the market came down and dropped so significantly. And again, on that Friday before the Monday when we did the presentation, the market just came apart and dropped, right? Okay. I was buying. Here again, now I am not happy about the market. I see political risk. I see economic risk. However, the market was so severe and took such a severe drop. I bought hundreds and hundreds and hundreds of thousands of dollars of stock the preceding Friday because those orders that I showed you earlier, they just get clicked up, bing, 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 buy, 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 buy. So I end up with a lot of long positions coming into the private seminar that we're holding in Bangkok. And during that private seminar, I showed exactly why I bought those stocks and where I bought them. They were all at nice DiNapoli levels. And we actually managed to, I was in profit on Monday, believe it or not. Market got lower, but most of those stocks were in profit on that Monday. So I am still willing to take long positions, even though I basically feel the risk is too high, and hold those positions according to the bread and butter trade. So here's a picture of that. Here's a picture of that market drop. And this is where I got long, and this is where you close those longs, right there, okay? And if you got short at that level, which I did, then as soon as you close over the 0.618, you get out. You don't stay in that short position. So here again, technical analysis got me a nice profit from these lows up to the 0.618, and it kept me, I wouldn't say the right way because I didn't take advantage of that subsequent up move. But I did hedge off any short positions I had remaining with long gold, silver, palladium, natural gas. You know, that was my hedge. That I had to get the hedge on there because the technical analysis told me to. The point over and over, what I'm trying to tell you is you got good technical analysis, it's going to keep you the right way, or it's going to make you money. I mean, you know, you can't be wrong for long. But if you listen to all these pundits on television, YouTube, etc., some of whom I respect greatly, some of whom are brilliant. I'm going to tell you a few who I watch in a minute. You're a hell of a lot better with competent technical analysis. And I'm not talking about a 200-day moving average. What good's that going to do you? That's 1970s stuff. I'm talking about the good stuff. All right. All right. Let's talk about a recent move in silver. What's the news? LBMA is failing. There's a silver squeeze. There's a financial reset. There's dollar debasement. This is the news, the news. Oh my God, silver's going to go to 1,000. You know, this is the shit that you're hearing. What happened? All right. So we're at a quarterly, we are at a quarterly XOP. Silver takes out the old high. There's a wash and rinse. Now, if you're a DiNapoli trader, I mean, you know you're in serious risk above here, regardless of the freaking news. And what happens is you come up here, you do a wash and rinse. I got out of all my silver, every bit of it right up there. And I was very happy that I did. Now, subsequently, I got back in because I'm positive this market, but technical analysis told me to take profit. By the way, okay, so here's where I took profit, right around here someplace, wherever. By the way, I'm trading paper silver, not real silver, not the futures. So here's where I took my profit, and here is my re-entry because I was back down at the quarterly XOP. So I re-entered here and I'm back out now because I hit the 0.618. So I had the thrust up. I got out at the DiNapoli level, way up there after a wash and rinse. That's one of our patterns. And I got back in. I must have made 10% in a day or 2 days. And I did the same thing with palladium. I held my gold, my paper and my physical, but I got out of a lot of this other stuff. So now I have sold my silver at the 0.618. Silver is hanging right here at the XOP. Am I bullish or bearish? I am very bullish on silver, but I think that there's a strong likelihood we're going to do an A, B, C, COP, ROP, XOP, and I will re-enter at a lower point. The only thing I have left is I got out of my gold, my paper gold. I still have physical gold. I got out of my palladium, re-entered a 50% position at a Fibonacci pullback. So what I'm trying to say to you is all this news, which is so bullish, the metals market, in which I agree with. I'm not disagreeing with them. You know, I'm just not trading according to the news. I'm trading according to technical analysis, which is proved over and over again to work. Now, I want to talk to you briefly about some of the guys that I watch on YouTube that I find interesting and I think are really good. You might want to watch them too. Lacey Hunt, he's probably the best economist that you and I have access to. There are better economists, but the hedge funds pay them and we don't have access to them. So this guy, he is really good. I mean, he's great, right? And based on watching him for the last couple of years, I would say that he's way upside down the bond market. He thought that because the economic shit was hitting the fan, that, and which I agree with, that interest rates would fall. And of course, he'd make a lot of money on long-term bonds. Well, I made pretty good money on long-term bonds, but it wasn't the way he was doing it. I was buying at deep DiNapoli levels and selling out quickly, buying at deep and selling out quickly. All right. Now, he is great economist, and I believe, you know, I don't want to mischaracterize the guy, but I believe he's been the wrong way for years. Michael Penno, he is a guy, his positioning and his feelings about the markets, I mean, I can't believe it. They are lockstep with me, absolutely lockstep. Now, this guy has forgotten more about fundamental analysis than I will ever know. He's really, really good. I think he's weaker than I am on a technical analysis. I don't know what he uses, but I do know his positioning because he talks about it when he's on YouTube. My positioning and his positioning are lockstep. I mean, it's absolutely perfect. He keeps saying, oh, I love to short this market, I love to short this market, but I can't. Technicals won't let me. I want to short the market's terrible, but I can't. The technicals won't let me. So like me, he has made a reasonable amount of money, not a lot of money over the past 5 years. And you really, I mean, you should listen to him. He's good. Ed Dowd. Ed Dowd is an incredible statistician, right? He nailed the whole COVID thing. And I mean, using statistics and whatnot. And the guy is really good with regard to the market. By the way, he is right now, he's very positive on bonds. He thinks interest rates are going to come down. Well, 2023 expected a recession. 2020, he still expects a recession. And somehow he thought the recession would affect the stock market, which of course we know it doesn't. Look at Venezuela. And besides, there was no recorded recession. He was wrong. One of the guys I respect the most, he was wrong. Had you listened to him and thought that the market was going to come down because of the fears of recession, then you'd have been wrong. You'd have lost money. But he's worth listening to. Now, there's this other guy, Michael Howell. I've just found out about him probably in the last couple of months. And he's, for lack of a better word, a liquidity expert. I think this guy's been mostly right. So if you had actually listened to him over the past 2, 3, 4, if I had listened to him, I probably would have done better. if I had acted on him. So in this case, the news, fundamental analysis, probably would have done us some good. So I'm not saying that you can't find somebody out there among 1,000 fundamental analysts that will give you news that would actually help you. You know, this is possible, but how do you know which one it is? You know, how do you know? Now, in the case of Ed Dowd, for example, and he's recommending bonds. I don't want to say recommending. He thinks bonds are going to go up. How do we play that as DiNapoli players? Okay, we use Ed Dowd's prediction because he's a smart guy. We use his prediction, and then we apply our technical analysis. And if our technical analysis says, yeah, this looks really good, okay, then we might consider doing it. But we just don't take these recommendations without proper technical analysis. So the bottom line is, like Louis Rukeyser and most market newsletters, et cetera, is that the fundamentals and the experts are for entertainment. It is financial entertainment. Now, I'll tell you straight out, I would rather watch somebody good like Ed Dowd or Michael Pinto than I would a movie, a decent movie. Why? Well, because I find it incredibly entertaining, but I don't make financial decisions on this. So this morning we'll be morning here. I'll be going in and finishing my yoga because it's a little bit early. And while I do the yoga, I'll have financial, some of these guys that I like, I'll try to find them and listen to them because it's entertaining, not because I expect to make any freaking money from it. Now, they might provide me some context like Dowd is doing with bonds. And, you know, I'll look at the technical analysis, I'll see if it works. Okay, so look at financial news and look at these bullshit reports that tell you inflation is, 3%. Bullshit, 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 okay? Look at them and look at it like financial, like entertainment. I meant being entertained. Don't think you're going to look at it and be smart and make money. I haven't, after 55 years in the market. I don't know, maybe you're better than me. Maybe you can figure out what these guys are saying and make some money. High quality technical analysis, and I think DiNapoli Levels provides that for you. Maybe there's some other stuff out there. If there's anything better, I'd be using it, and I can't find it. But anyway, keep you the right way or minimize your losses. And I think that's the end of the presentation. I hope you guys learned something. I don't know if there's any time left. I'm happy to take a question or two or three. Piotr, I love you, but I can't hear you.
Yeah. Now you hear me? Hello? 1, 2, 3. Do you hear me? You hear me? 1 second. John? John? You hear me now?
Yes.
Yeah. Oh, good. Nice. All right.
Piotr, you're breaking up really badly. So if you can talk slow, I might be able to hear you. I just turned the volume way up.
No. Okay. Oh, thank you very much for your presentation. And yeah, I'll ask if there are any questions. Do you read me?
I hear you, but I can't understand you. Are you, Piotr? I have a question for you. Piotr, Are you speaking? Hello, Piotr. Are you speaking Polish, English, or Thai? Because I can't understand.
We are trying to decide. Okay, what I'm saying.
We can hear you very well. Okay, I know you can hear me, but I can hear you too. I just can't understand you.
Try to read. We text you. Text.
You know what it is there's an echo in the room. And it's not like my hearing's great to begin with.
Dobra, słuchajcie. Macie jakieś pytania do
Czy kiedyś czy to jest bańka, czy to nie jest bańka?
Joe, you can hear me now better? Or
Oh yeah, I can hear that perfectly. Yeah, that's good.
Okay.
Okay.
You hear me now?
Oh, that is wonderful. You're crystal. I'm glad you're speaking English. This is great.
And I guess you can see me too.
Well, you're a little off camera. I see all the There you go. I see you.
All right, nice. Well, Joe, first of all, thank you for entertaining us.
That was my objective.
No, it was a pleasure to hear you and see you in good shape. We really love to see you. Great you took time in the morning and get us along the basic points, which is just believe in your strategies and look up to your technical analysis and use the market information, never use them for your trading. Well, in general, let's do summarizing. And
well, you know, Piotr, the thing is that these guys, some of them are really brilliant. All right, they're very, very smart, right? And they come on and they're authoritative and they've got impressive backgrounds, and you're seductive. It's like looking at a beautiful girl, right? I mean, you go, wow, you know, that's incredible. And these financial experts come on there, it's seductive. And you end up going, well, you know, sounds reasonable, I'll go along with that. And if you don't consult your technical analysis to verify that what they're saying is actually happening, you're in big trouble.
yeah, nice. Well, there was a question. Hello?
Yeah, I see you.
There was a question when this market will finally, well, break down.
I think about a year ago. Look, this market, I think the market's done, okay? Right now, I'll tell you my positioning. I've just gone, I run my accounts like kind of like a hedge fund where I am both long and short. And so if I close my long positions, then I become net short. And that obviously I'm negative. So I have closed, not all, but most of my long positions. And I am now currently net short. So I think we're there now, and this market could come apart any time. The political risks are enormous here in America, and Trump has lost his mind. And you know, I think we're in real trouble. So if the market, you know, edges back up, and if it exceeds the 0.618 of the last down move, and if we, you know, obviously if we take out the highs and don't create a wash and rinse, I'm not going to be net short anymore. I'm going to listen to the technical analysis. But right now, I'm net short.
All right. Well, would you be short the index, or would you be short some particular stocks? That's my question.
Both.
Both. Okay. Right. Well, any other questions, maybe? What would you think about crude oil? Well, in general, of course, not speaking in specific numbers out of your head, maybe. It's just a question. What would you think about?
Okay,
crude
I'll
oil?
tell you what right now, the technicals are negative. They're not positive. They're not screaming negative. but they're not positive. Now, fundamentally, and believe, look, my fundamental analysis is no better than anyone else's, right? Fundamentally, I think we can have a dip lower where we have demand destruction, and we could go quite a bit lower, and that will be a buying opportunity. That's my base case on oil. Am I short? No, but if we get down to, I don't know, $35 oil, $25 oil, somewhere in that area, I'll load the boat. I will get aggressively long. And of course, the news is going to be terrible. News is going to be awful. I'll load the boat. Yeah.
As far as I remember, a monthly chart on crude oil, you see that from 3 or 4 months the chart is leaning against the MACD predictor, and it's just, it's like somebody's keeping it from rallying above the MACD predictor, pushing it down.
I agree.
Yeah. Sorry, 1 second. Would you think of buying some old baby drill stocks, kind of, you could name some, or just related to crude oil market?
I'm already long RIG, Transocean. I mean, that was $170 stock. It's been flirting with the $3 and $4 level. I usually don't buy $3 stocks, $4 stocks, but I have a significant position in that one. And see, crude oil could actually come down quite a bit, and Transocean could be good. And the reason I say that is because political risk. I mean, it's much easier for Trump to steal Venezuelan oil than it is for us to go on a serious drilling campaign. And I don't think he's going to be able to steal Venezuelan oil. And I think if there's more political disruption in the Mideast, which is, I think, very likely given the situation with Israel, then we could have a situation where there's going to be a lot of drilling in America, even though the actual oil price might drop due to demand destruction. So that's my feeling on the situation. I think other oil service companies, it depends on where they're located, but I think in the U.S. That would be good. And if the U.S. is successful in overthrowing the government of Venezuela and killing millions of people like they usually do, then I suppose that anybody that's drilling down in Venezuela, that would be positive as well.
Okay, well, thank you very much. As this is our 10th anniversary, Joe, we've been seeing each other maybe for the last 5 or 6 years here. I would love to have some kind of to get a picture. You be there and us maybe standing around you, if you will. And jeżeli macie ochotę przy okazji 10-letniej naszej imprezy stanąć, zrobimy sobie zdjęcie wspólnie z Joe na pamiątkę. Yeah, would you?
Yeah, I'd love that. That'd be wonderful. I wish I was there in person. I just had too many things I couldn't change, prevented me from coming.
And after picture, Joe, we'll come back.
Okay.
Would you like to smile? Thank you.
There we go. It's easy to do with all my friends there in Poland. Should I keep smiling?
Few seconds more. Thank you.
You're welcome. Piotr, I want to say a couple of words to you here before we close this thing down.
Yeah. Well, let us go back to our seats. We just had the picture, so one small second. Let us sit down. All right. Well, yeah. Go ahead.
Yeah, I want to personally thank Piotr and the staff and all my friends.
You
Have I
have
got the
turned
floor?
off your speaker of your microphone.
I have not. No, I haven't done anything. 1, 2, 3. Can you hear me?
I don't hear you.
Can you hear me? 1, 2.
One second.
Hello, hello.
Joe?
Yes.
Joe?
Yes.
We did not hear you. So please.
Okay, can you hear me now?
Yes, we do hear you. So please start again.
All right. I want to personally thank Piotr for putting this DiNapoli Day event on over the past 10 years. It's been wonderful. I mean, I think it's been of great benefit to the Polish traders and to other people that have seen the broadcast. And look, if you guys have never put on one of these things, you don't know how much trouble is involved. And I've known Pio more than 20 years. He's a great trader. He's a great organizer. He's a great person. And I want to give him my personal thanks for doing this for so many years and for spreading the word. And I think he deserves a hand. So let's everybody give Piotr a hand for doing this.
I love you too. I love you too.
Not as much as I love you.
You bet.
If you've gotten this far, you've seen at least one of our videos. We've been at this for 40 years. Long time. We've been teaching traders just like you. If you want to experience the amazing power of DiNapoli leading indicators, go to fibtrader.com. You'll find a variety of products there that'll help you learn this material. You know, everybody's got a trading solution for you. Best material possible, right? Well, we're the only ones with high quality technical leading indicators. You can't find it anywhere else. We thought about this though, and we have a recommendation for you. First of all, the book is absolutely critical. You can't get away without it. Get the book, study the book, get on the forums. They're free if you buy the book, and get your questions answered. Then there's Peter Van Wyck's D-Level Financial Forecast. We think it's unrivaled as an educational source, and it's packed full of trading ideas in a variety of markets. But you're going to need some knowledge to understand it, and that's why we recommend you get the book and study it first. The links are below. Finally, right up there in the corner, there's an introductory video done by Peter Van Wyck. It's worth you checking out. Good luck and good trading.